Hello, everyone. Welcome to Edgemoor Investment Advisors' third quarter 2021 presentation on current market conditions and outlook. I'm Gay Truscott, and I am joined today by my colleague Tim Coughlin. We are pleased to be back making this presentation for our clients and friends. Our agenda for today will follow the quarterly newsletter, which went out to you folks last week and is also posted on our website and blog. I will discuss the current state of the economic recovery, review the stock market's pause in the third quarter, and give an update on the Fed and Congress, as well as our outlook for markets for the remainder of the year. Tim will then discuss two selected securities which we are currently buying and conclude with a few closing remarks. We encourage your feedback on this presentation, as well as ideas you may have for future presentations. So please feel free to call or email us with your thoughts. Let's get started. The third quarter of 2021 began with renewed hope for the return to some normalcy, but the rise of the highly contagious Delta variant of COVID-19 over the summer created some setbacks. The dark red line in the middle of this busy graph shows how the Delta variant began its surge in the United States in early June and peaked through early October, which had the effect of slowing the economic recovery. You can see this in the next slide. U.S. GDP growth, which was very strong in the first two quarters of 2021 at 6.3% and 6.6% respectively, likely slowed somewhat in the third quarter to 5.5% and is expected to further slow to 3.9% in the fourth quarter. Notwithstanding this, these numbers still signal robust U.S. GDP growth. We saw more good news on the employment front as well, with the U.S. unemployment rate falling to 4.8% in September after peaking at 14.8% during the height of the pandemic in March of 2020. Most estimates are for it to decline further to 4% in 2022. U.S. wage growth is also at its highest level in 2 decades, as you can see in this chart of the monthly percentage increases in U.S. wages since September of 2020. Wage growth is being driven largely by the fact that employers are having to compete for fewer available workers due to pandemic-related retirements, work disincentives from federal leave payments, and ongoing COVID concerns. There are several economic headwinds which we saw accelerate during the third quarter. Supply chain disruptions, particularly in the manufacturing, construction, retail, and semiconductor sectors, continue to ripple through the economy. The surge in demand over the last year for everything from homes to cars to appliances has resulted in logistical bottlenecks and supply shortages around the globe. Although we expect these supply chain disruptions to ease in the coming months, they have already led to a noticeable spike in inflation in many sectors. Core CPI, the broadest measure of inflation, which strips out volatile food and energy prices, rose 4% year over year in August and September after starting its surge in the May-June timeframe. Although it is expected to decline to a more moderate 2.5% in 2022 when the supply-demand imbalance corrects itself, Americans are already feeling the pinch on their wallets. Let's move to the stock market now. As shown in this chart, the S&P 500 has risen over 100% from its pandemic low point of 2237 18 months ago to just over 4,500 yesterday. But in the third quarter, the S&P took a pause, returning just 0.6% for the quarter compared to 6.2% in the second quarter. For the month of September, the index actually declined 4.7%, the first negative return month in 2021. Despite this pullback, the S&P 500 is still up an impressive 21.7% year-to-date through yesterday, October 19th, reflecting the fundamental strength of the economic recovery and corporate earnings. Now let's turn to the Fed. The Federal Reserve, which has maintained very accommodative monetary policy to support the economy through the pandemic and the recovery, signaled in September that it will likely begin tapering its $120 billion monthly bond purchasing program by the end of 2021, rather than in 2022. This accelerated timetable, though widely expected, has boosted Treasury yields back above 1.6% for the first time since May. However, the Fed has also indicated that it is in no hurry to raise the short-term Fed funds rate from its current level near zero. Most economists expect that will not happen until 2023, which should be positive for equity markets and the economy. In addition to monetary policy, fiscal policy has been a key feature of the economic recovery in the United States. From the massive fiscal stimulus measures passed by U.S. lawmakers during the pandemic to the current proposed infrastructure legislation being debated in Congress, U.S. consumers and U.S. businesses have benefited greatly from government spending. Where fiscal policy goes from here remains unclear. While the bipartisan $1 trillion infrastructure bill seems likely to pass, the larger human infrastructure bill seems destined for significant cuts due to concerns over exploding deficits and debt. The Biden tax proposals, which are designed to raise revenue to pay for his infrastructure bills, also face great uncertainty. However, all signs point to higher taxes for high-income earners. This slide shows what's currently in and what's currently out of the latest proposal. What's in includes a rise in the capital gains rate tax from 20% to 25%, a rise in both the top individual and corporate tax rates, and a decrease in the individual federal estate tax exclusion from 11.7 million to approximately 6.2 million. What's out is the elimination of the step-up in cost basis at death, which protects inherited appreciated assets from capital gains tax. This, we believe, is good for investors and business owners. Now to our outlook. In our view, the outlook for U.S. equities remains positive. Stock valuations are elevated, but not unreasonable, given the backdrop of still historically low interest rates and strong corporate earnings. The positive factors we see include continuing economic expansion, corporate earnings that have been strong and growing, the likelihood that some level of infrastructure legislation will pass and inject trillions of dollars into the economy over the next 5 to 10 years, and improving vaccination rates that should get us to the other side of this pandemic. There are, of course, challenges which we are watching carefully. They include rising interest rates, rising inflation that may not be as transitory as first believed, and supply chain disruptions and shortages. Overall, though, we have a positive long-term outlook for the stock market, although we expect that volatility and other challenges will remain in the near term. Now I will turn it over to Tim Coughlin to talk about 2 selected securities we are buying and offer some closing remarks.
Thank you, Gay. Here are 2 of our current stock selections. First is Alphabet Inc., often referred to as Google, which we are currently buying for its appreciation potential. Second is Ares Capital Corporation, which we are currently buying for its high dividend yield. As shown in this slide, Alphabet stock has appreciated 79% in the 12 months ending September 30, 2021. Alphabet is a global technology company, best known for its dominant internet search engine, Google, which controls more than 80% of the market for online searches. In addition, Alphabet's array of other services and applications include Gmail, YouTube, Google Apps, Google Earth, and Google Play. The company also owns the Android mobile operating system, which powered roughly 73% of smartphones globally as of June 2021. Together, these core assets provide a cohesive, end-to-end experience for consumers and, most importantly, drive advertisers to Alphabet's platforms. Most of the company's revenue is derived from advertising, where they are the dominant online presence. In the rapidly growing enterprise cloud market, Google Cloud is currently the number 3 player, trailing only Amazon Web Services and Microsoft Azure. Google Cloud may grow into one of Alphabet's largest business segments. In our view, Alphabet is financially strong. The company has grown its revenues at a compounded annual rate of 19% since 2011 and is projected to deliver annual earnings growth of nearly 20% over the next 5 years. Additionally, the company's balance sheet is solid, with $136 billion of cash and marketable securities and only $14 billion of long-term debt as of June 30, 2021. At approximately 26 times forward earnings, Alphabet stock trades at a premium to the S&P 500 average price earnings ratio of 21.5 times. But we believe Alphabet's higher than average growth prospects and strong competitive advantages justify the premium. Second, here is Ares Capital Corporation, which we are currently buying for its high dividend yield of 8%, as shown in this slide. The company has paid a continuous dividend since its initial public offering in 2004. Ares Capital is a specialty finance company that provides debt and equity financing primarily to private middle market companies in the United States. The company invests in various industries, such as automotive services, business services, consumer products, and containers and packaging. With a market capitalization of $9.5 billion, Ares Capital is the largest business development company regulated under the Investment Company Act of 1940. As a regulated business development company, Ares is required to pay out 90% of its taxable income in the form of dividends to its shareholders. In addition to its high dividend, Ares Capital investment objective is to generate capital appreciation as well. As shown in this slide, its total return for the 12 months ending September 30, 2021, including both dividends and capital gains, was 54%. With cash and investments of approximately $17.5 billion and debt and operating leases of $9.4 billion, Ares Capital's balance sheet has ample liquidity and relatively low leverage. Ares also enjoys an investment-grade debt rating from all 3 credit rating agencies. We believe Ares Capital is an attractive, long-term income investment due to the company's leading market position, conservative investment philosophy, attractive growing dividend, and opportunity for continued price appreciation. Gay and I are now at the end of our presentation of the economy, the markets, and two of our favorite stocks we are currently buying, Alphabet and Ares. We are also pleased to let you know that Steve LaRosa, a CFA, has joined Edgemoor as a director and senior portfolio manager. Steve has more than 20 years of experience as an investment advisor, most recently at Bank of America Private Bank, where he was responsible for managing over $1 billion in client assets. Please join us in welcoming Steve to the Edgemoor team. And thank you for tuning in to Gay's and my video presentation. Stay safe and best wishes.